Silver didn't move the way it was supposed to. It didn't climb step by step, testing resistance, giving traders time to react. It skipped levels. Prices jumped into empty space where sellers should have been waiting, and that silence is louder than any headline. Markets don't gap up because of excitement. They gap when something breaks beneath the surface. For years, silver was treated as predictable, secondary manageable. A market where leverage felt safe and paper promises felt interchangeable with metal. That belief created comfort, and comfort created concentration. Positions grew larger, inventory buffers grew thinner. Risk was hidden in plain sight because nothing forced it into the open, until one session did. A gap is not a rally. It is a refusal. A refusal to sell, a refusal to provide liquidity, a refusal to pretend that supply is infinite. It tells you that price discovery failed, not because demand surged, but because availability vanished at critical levels. Someone needed silver and couldn't wait. The question now is not how high silver can go or how fast it can fall. The question is, what happens when a market built on rolling promises collides with real-world constraints? Once that collision begins, history shows it rarely resolves quietly. Origins: how silver became a pressure cooker. Silver began its role as a pressure cooker because it is fundamentally a hybrid asset that never quite fits a single financial model. It carries monetary history as a store of value while simultaneously serving as an industrial input that is consumed and transformed. Those twin identities create persistent tension. Investors treat silver like a hedge against fiat debasement, while manufacturers treat it as a raw material to be purchased and used. Over decades, the structure of the market evolved to accommodate this tension by layering a paper market on top of limited physical flows. Futures exchanges and over-the-counter contracts multiplied claims on ounces much faster than mines produced them. Paper positions are useful because they provide liquidity and enable price discovery when trading is orderly, but they also permit leverage and concentration that obscure the actual available metal. When most participants assume only a handful of contracts will demand delivery at a time, they are comfortable building hundreds of paper claims against a single visible inventory. That belief makes the system efficient in calm conditions and fragile when stress increases. Physical demand steadily changed the risk profile in ways that were easy to miss. Industrial consumption grew as new technologies scaled, from electronics to photovoltaics to medical devices. Unlike gold, silver often becomes embedded in products and does not return promptly to the market. Recycling helps, but cannot instantly replace ounces diverted into long-lived equipment. Meanwhile, mining output faces long lead times. Opening a new mine or expanding capacity requires capital planning, measured in years, and regulatory approvals that create inertia. Supply cannot flex quickly to price signals. At the same time, inventory reporting and warehousing practices concentrated metal into specific vaults tied to settlement systems. Those visible stocks can fall even as overall global production remains steady because distribution matters. When bullion leaves exchange-affiliated warehouses to satisfy industrial or retail demand, replaceable liquid stocks shrink and paper claims look more precarious. The pressure cooker becomes obvious when these elements interact under leverage. High open interest in futures increases the sensitivity of the market to margin calls and forced covering. A relatively modest change in sentiment can cascade into a liquidity vacuum if many participants attempt to trade at the same instant. Retail premiums for coins and bars rise because dealers cannot source replacement metal without paying more, which further disconnects spot prices from paper quotes. Regulatory and exchange responses such as adjusting margins or imposing limits attempt to stabilize trading, but often accelerate the short covering that feeds higher prices. In this way, the origins of a gap are structural rather than accidental. The hybrid nature of silver, the slow responsiveness of physical supply, and the asymmetric risks that leverage imposes create conditions where a sudden reassessment of availability will translate into abrupt price moves. Understanding those origins is essential for anyone trying to interpret a gap and judge whether it is a temporary dislocation or the beginning of a longer reallocation of risk and metal. Historical episodes underline this dynamic without guaranteeing identical outcomes. Previous squeezes demonstrate how quickly perceived abundance can vanish when concentrated positions confront delivery mechanics and many actors demand physical settlement instead of rolling paper positions. Modern market plumbing and rapid information transmission can accelerate moves, but the essential mismatch between immediate industrial and retail needs and the slow pace of mining persists. That unresolved mismatch is the kernel that can convert ordinary volatility into broader systemic stress during abrupt repricing and reshape market behavior permanently. The rise. Signals the market tried to ignore. The rise of silver unfolded as a slow accretion of forces that appeared benign when examined one by one, but dangerous when stacked together. Industrial demand increased as electronics manufacturing, solar installation, and specialized medical equipment consumed ounces that rarely returned promptly to circulation. Mines could not respond quickly because expanding production requires geology, financing, and permitting measured in years rather than quarters. At the same time, financial demand grew as investors and speculative traders searched for alternatives to low-yielding assets, increasing paper claims on limited stocks. Distribution dynamics concentrated metal into industrial inventories and private holdings, reducing the visible liquid supply that exchanges rely upon for quick settlement. These structural elements created a system that looked efficient during calm markets but brittle under strain because the apparent abundance depended on a steady flow of available physical ounces that was becoming less certain. Mining slowdowns from unexpected interruptions, logistical bottlenecks in freight, and increased demand for smaller retail formats all exacerbated the perceived scarcity, making even routine trades require more coordination and more time than historical norms allowed. The combination of enduring consumption and constrained replenishment quietly changed risk calculations across participants. Warning signs began appearing across multiple metrics, but were often dismissed as temporary frictions rather than a coherent narrative pointing to scarcity and urgency. Backwardation in nearby futures suggested buyers were willing to pay a premium for immediate delivery, a rare condition that signals stress in physical markets. Retail dealers started quoting higher premiums and longer delivery times for coins and small bars, evidence that at the grassroots level sourcing had become more difficult. Exchange-affiliated warehouses reported net withdrawals, which reduced the pool of metal available for prompt settlement and left paper markets increasingly exposed to the availability of physical ounces. Open interest in futures and options remained elevated, indicating many outstanding promises to buy or sell at future dates, even as visible inventories shrank. Options skew, and the concentration of short positions in the front months increased vulnerability, because a relatively small change in sentiment could force concentrated covering. Meanwhile, bullion exchange, traded funds, and institutional warehouses saw flows that tightened the marginal supply further, creating a feedback loop where reduced visible supply pushed premiums and perceptions of scarcity higher. Analysts and market participants noted these confluences, yet many treated each data point as isolated, missing the collective implication. The conversion of warnings into an acute event depends on a set of mechanical and psychological feedbacks that accelerate once triggered. When order books thin, liquidity providers widen spreads and reduce depth to protect capital, making it easier for larger buy orders to move price and harder for sellers to absorb demand. Algorithmic strategies that sold into rallies can flip into buyers when short covering begins, amplifying momentum in minutes. Margin systems demand more collateral as volatility rises, prompting forced deleveraging and additional buybacks to cover shorts. Programmed orders often fail to operate smoothly in thin markets, producing gaps rather than steady moves. Short concentration among a few large players becomes systemically important because inability to source metal by one party can propagate stress across counterparties. Media attention and retail momentum can magnify flows and extend squeezes, turning technical stress into broader market repricing. Policy measures and exchange actions meant to restore stability, such as higher margins or temporary limits, can have the unintended effect of accelerating covering and reducing intermediation. Taken together, these dynamics show why the earlier signals mattered. They were not isolated frictions, but components of a fragile structure that yields abrupt repricing when confidence about immediate availability falters, driving rapid and persistent repricing now. The breaking point, when the system couldn't absorb pressure. The breaking point arrives when accumulated stress converts from latent risk into immediate action, and silver reached that threshold when liquidity disappeared between trades. At the open, bids overwhelmed offers and prices leapt across levels where sellers had previously clustered, leaving a visible gap that signaled absence rather than enthusiasm. Such gaps emerge when participants refuse to sell because replacement costs are uncertain or unavailable. Short sellers confronted rising margin demands and shrinking inventory, forcing rapid decisions under pressure. Some attempted to roll positions forward, others rushed to cover, and a few faced the prospect of standing for delivery in a market where metal was no longer abundant. Each choice carried escalating cost, and together they compressed time, turning days of adjustment into minutes. This is the precise moment when leverage stops amplifying profits and begins amplifying fear, because losses expand faster than capital can respond. The gap, therefore, marked not a speculative surge, but a structural failure of smooth price discovery, exposing how dependent the system had become on continuous liquidity. Confidence fractured quietly, revealing mismatches between paper claims and deliverable ounces that could no longer be reconciled without significant repricing across the entire structure of modern silver markets. Once the gap formed, cause and effect accelerated through the system in predictable but unforgiving ways. Price jumps triggered margin recalculations that forced leveraged participants to post additional capital immediately or exit positions. Exits meant buying back contracts, which intensified upward pressure and widened spreads. Liquidity providers stepped back, unwilling to quote aggressively when inventory risk and volatility spiked simultaneously. This retreat magnified each incremental order, producing outsized price responses from relatively modest volume. Physical markets reacted with equal speed. Dealers raised premiums to hedge replacement risk, and industrial users quietly moved to secure supply before conditions deteriorated further. Inventory withdrawals from exchange-linked warehouses compounded the signal that available metal was shrinking, reinforcing urgency. Algorithms that had been designed for mean reversion flipped direction as trend signals activated, transforming former sellers into momentum. Buyers. Psychological dynamics compounded mechanical ones, as disbelief gave way to fear of missing coverage. The gap thus became a coordination point, aligning diverse actors toward the same urgent behavior. Instead of stabilizing price, each rational response deepened imbalance, illustrating how tightly coupled modern markets transmit stress once a critical threshold is crossed. Speed replaced deliberation, and feedback loops dominated outcomes beyond individual intent and control. The breaking point also reframed how participants interpreted information and authority during the event. Exchange announcements, regulatory commentary, and analyst reassurances lost potency against real-time price signals and delivery constraints. Market actors began prioritizing tangible access over theoretical hedges, shifting preferences toward physical possession or near-dated contracts. This behavioral shift matters because it changes demand elasticity precisely when supply is least flexible. Efforts to dampen volatility through higher margins or position scrutiny often intensified moves by compelling weaker holders to liquidate, reducing liquidity further. As volatility expanded, correlation assumptions failed, and silver decoupled from traditional anchors, moving independently of gold or broader risk assets. This independence challenged long-held narratives about silver's subordinate role and forced reassessment of exposure models. For observers, the episode clarified that the breaking point is not defined by price alone, but by credibility of settlement mechanisms. When confidence in smooth rollover erodes, markets reprice not just metal, but time and certainty. That repricing can persist even after volatility subsides, altering behavior long after headlines fade and embedding a new risk premium into silver trading frameworks. Such moments redefine participation thresholds and influence strategic decisions for years across institutions and individuals alike globally today. Fallout. Who feels the pain first? The first casualties are the most leveraged and the most short, because mechanical margin systems turn a market hiccup into immediate capital demands. Hedge funds and proprietary desks that had built concentrated short exposure against a quiet silver curve confront margin calls when price gaps force mark-to-market losses. Brokers demand collateral. Prime brokers and clearinghouses reassess counterparty risk in real time. The arithmetic is simple but brutal. A moderately sized adverse move can consume equity rapidly when positions are levered 20 to 50 times. Forced liquidations follow, each one adding buying pressure and widening the gap between theoretical fair value and executable prices. Meanwhile, algorithmic liquidity providers withdraw or widen quotes to protect themselves from inventory losses, removing the very market depth the ecosystem needs to absorb stress. The result is a chain reaction. Losses beget margin calls. Margin calls beget forced trades. Forced trades beget further volatility, which concentrates pain on those who relied on short-term financing and assumed continuous liquidity. The second wave hits market intermediaries and physical suppliers who must reconcile paper positions with deliverable metal. Dealers, who had promised same-day or short data delivery, find sourcing increasingly costly. Premiums for coins, small bars, and allocated bars rise as dealers hedge the risk of replacement at higher prices. Exchange vol. Affiliated warehouses can show sudden net outflows as industrial users and private buyers convert paper exposure into physical possession, shrinking the pool available for prompt settlement. That scarcity reveals itself in delivery fails or stretched settlement windows, and these operational frictions have reputational consequences for intermediaries and exchanges. Industrial users then face practical choices: pay higher premiums, delay production, or seek substitute materials. For sectors that depend on silver, electronics manufacture, solar panel assembly, and certain medical device lines, these decisions are not academic. They translate into higher input costs, revised production schedules, and sometimes contractual disputes if delivered components do not meet timing requirements. Smaller dealers and regional mints which lack deep sourcing ties may be squeezed hardest, unable to compete with large institutions that can outbid them for available metal. The broader systemic fallout is subtler but more persistent because it changes behavior and pricing across time horizons. Investors reassess the liquidity premium they assign to silver, often increasing allocations to physical holdings or storage solutions, which can further tighten near-term availability. Exchange-traded products and funds that rely on synthetic exposure may see reflows or redemptions that force them to buy or sell in stressed conditions, embedding volatility into fund-level operations. Clearinghouses and regulators examine margin frameworks, position limits, and reporting transparency, and may impose changes that alter market structure, sometimes improving resilience, sometimes creating new constraints that reduce elasticity. Credit relationships are revalued as counterparties price the probability of similar episodes recurring. Collateral haircuts rise, and cost of capital for participants in the silver complex increases. Ultimately, the pain diffuses. Short-term losses hit traders first, but rising premiums, disrupted supply chains, and higher hedging costs reach corporates and consumers thereafter. The lasting effect is behavioral. Participants who lived through the event change thresholds for acceptable risk, reconfigure hedging strategies, and demand greater clarity about the link between paper promises and physical metal. These adjustments can persist long after headline volatility fades, reshaping markets by embedding a new premium for immediacy and certainty. Failed fixes. Why control measures often backfire. When volatility erupts in silver, authorities and exchanges respond with tools designed for stability but calibrated for calmer conditions. Margin requirements are raised to curb leverage, position limits are discussed to reduce concentration, and surveillance language intensifies to signal oversight. These actions are meant to slow trading, yet they often compress time by forcing immediate decisions. Higher margins do not reduce exposure smoothly. They compel weaker participants to liquidate, usually through buying back short positions at unfavorable prices. Liquidity providers widen spreads or step aside, unwilling to warehouse risk under new rules, which reduces depth precisely when depth is needed most. The market becomes thinner, not calmer. Participants who might have absorbed pressure gradually are pushed into synchronized behavior, magnifying volatility. What appears as control from a regulatory perspective functions as acceleration from a mechanical one, because forced compliance replaces discretionary adjustment. The system responds not by cooling, but by snapping to a new equilibrium defined by urgency rather than balance. Efforts to reassure participants through communication face similar limitations. Statements emphasizing orderly markets and adequate supply can lag real conditions on the ground, especially when physical flows contradict official narratives. Traders and industrial users prioritize executable reality over assurances, adjusting behavior based on premiums, delivery times, and warehouse withdrawals. Temporary rule changes may also create uncertainty about future interventions, encouraging participants to preemptively reduce exposure or demand physical settlement sooner than planned. This front-loading of risk shifts stress forward instead of dispersing it. Moreover, controls can distort incentives by rewarding those already positioned advantageously while penalizing late movers, deepening inequality of outcomes. Historical precedents show that once, credibility is questioned. Additional layers of management often require escalation to maintain effect, each step carrying unintended consequences. The market learns to trade the rules rather than fundamentals, and each intervention becomes another variable amplifying complexity rather than simplifying resolution. The failure of fixes lies in a mismatch between the source of stress and the tools applied. Structural scarcity, slow supply response, and concentrated leverage cannot be resolved through procedural adjustments alone. Time is the missing ingredient that controls cannot manufacture. Mining output cannot be accelerated by higher margins, and industrial demand does not pause because trading conditions change. As a result, interventions may succeed only in redistributing losses and gains while leaving underlying imbalances intact. Over time, participants adapt by holding more physical metal, shortening settlement horizons, or demanding higher premiums for providing liquidity. These adaptations embed lasting changes into market behavior, raising the cost of smooth functioning in the future. The paradox is that repeated attempts to impose stability can reduce resilience, making subsequent shocks more disruptive. Failed fixes, therefore, teach a quiet lesson. Markets clear when fundamentals realign, not when rules attempt to override them. Until supply, demand, and leverage converge naturally, control measures risk becoming accelerants rather than solutions, reinforcing cycles of stress instead of preventing them. Participants who recognize this dynamic often recalibrate expectations, accepting episodic volatility as the cost of operating within constrained systems. Education replaces complacency, and risk management emphasizes redundancy, optionality, and patience. While these adjustments are rational individually, collectively, they further tighten available supply during stress, reinforcing the same patterns that triggered intervention. Thus, the cycle persists, not through malice, but through structure. Each episode leaves scars in pricing models, contracts, and memory, shaping how future participants behave when pressure builds again. Over time, these scars accumulate, quietly redefining normalcy until the next rupture resets assumptions once more. This process repeats across cycles, indifferent to intention, confidence, or reassurance. The silver gap is not an isolated chart anomaly, but a message about structure, incentives, and time. Markets that rely on confidence and continuous liquidity function smoothly, only while participants believe delivery is optional. When enough actors decide immediacy matters, price stops being a signal and becomes a rationing mechanism. What follows is rarely linear. Volatility may retreat, prices may consolidate, and narratives will compete to explain away discomfort. Yet the behavioral shifts tend to persist. Participants remember scarcity more vividly than abundance. Risk models adjust, premiums linger, and hedging strategies become more conservative. These changes do not guarantee higher prices tomorrow, but they do reshape how silver trades, how liquidity is valued, and how stress propagates through the system. The market does not forget lessons learned under pressure. The open question remains unresolved. Can supply, incentives, and leverage realign without another dislocation, or will repeated stress events redefine silver's role across financial and industrial spheres? History suggests resolution arrives only when imbalance is addressed rather than managed. Until then, gaps serve as warnings, not conclusions, reminding participants that stability is conditional and temporary. If this breakdown added clarity, engage with the channel by liking the video and subscribing for deeper structural analysis. Share your perspective in the comments below.